you check your calendar. December 9th, 3 weeks left in the year. And somewhere deep in your brain, a little voice whispers that you should probably do something important before midnight on December 31st. But what? You tell yourself you'll figure it out next weekend. Then the weekend comes. You're buying last-minute gifts and dealing with family obligations, and suddenly it's January 2nd. And that little voice, it's screaming now. Because you just lost thousands of dollars that you'll never get back. Not because you spent it, not because you got robbed, but because you didn't act before an arbitrary deadline that our tax code treats like the financial equivalent of Cinderella's midnight. The carriage turns into a pumpkin. The tax advantages vanish into thin air, and the money that could have been yours, it now belongs to the government, to your employer, or to absolutely nobody. It just evaporates. My name is Alex, and for the past decade, I've watched intelligent, capable people lose enough money every December to fund a solid vacation, simply because they didn't know these 5 deadlines existed. And I need to tell you something that took me 3 years of analyzing tax returns and retirement accounts to fully understand. The financial calendar is rigged against procrastinators. Every major tax advantage in America comes with an expiration date, and most of them expire at midnight on December 31st, whether you're ready or not. If you want to keep more of your money and stop funding the IRS retirement plan, make sure to hit that subscribe button and give this video a thumbs up if you're tired of discovering tax advantages after they're already gone. Here's what I'm going to show you today. 5 specific moves that evaporate on December 31st. Each one represents real money. We're not talking about 20 bucks here. We're talking hundreds, thousands, sometimes tens of thousands of dollars that simply cease to exist as options once the calendar flips. And the brutal part? Most people don't find out about these until they're sitting with their accountant in March, hearing those 5 words that haunt every tax season. You should have done that. Well, not this year, not you. Because by the time you finish watching this, you'll know exactly what to do and exactly why waiting is expensive. Let's start with the move that confused me for years until I finally understood how powerful it actually is. Tax loss harvesting. Sounds complicated. Sounds like something only hedge fund managers do. That's exactly what I thought. That's the trap right there. Because tax loss harvesting is actually one of the simplest and most effective ways to legally pay less in taxes, and it only works if you do it before December 31st. Here's how it works. Let's say you bought shares of a tech stock back in March. You paid $5,000. Today, those shares are worth $3,000. You're down $2,000. That loss feels bad. It is bad. But here's what nobody tells you. That loss has value. Serious value. If you sell those shares before the end of the year, you can use that $2,000 loss to offset any capital gains you made elsewhere. Sold some winning stocks? Made money on crypto? Took profits on an index fund? That $2,000 loss wipes out $2,000 of those gains, which means you just avoided paying capital gains tax on $2,000. At a 20% capital gains rate, that's $400 in your pocket instead of the IRS pocket. 400 real dollars, just for selling something you already lost money on anyway. But here's where it gets even better. Let's say you don't have any capital gains this year. Maybe you didn't sell anything else. That loss still has value. You can use up to $3,000 of investment losses per year to reduce your ordinary income. That $3,000 deduction against your regular paycheck income can save you anywhere from $600 to over $1,000 depending on your tax bracket. And if your losses are bigger than $3,000, they roll forward. You can use them next year and the year after that, until they're gone. Now here's the critical part that trips people up. The wash sale rule. This is where the IRS says, not so fast. You can't just sell your losing investment on December 30th, take the tax loss, then buy it right back on January 2nd. That would be too easy. The rule says you have to wait 31 days before buying back the same investment, or anything substantially identical to it. If you violate this rule, your loss gets disallowed. You lose the tax benefit entirely. So if you want to maintain exposure to that investment because you still believe in it long term, you have 2 options. Either wait 31 days and buy it back in February, or sell it and immediately buy something similar but not identical. Sold an S&P 500 index fund, buy a total market index fund instead. Similar exposure, different enough to avoid the wash sale rule. The deadline is absolute. Sales must settle by December 31st. Stocks settle in 2 business days. So if you wait until December 30th or 31st, you might be too late depending on how the calendar falls. This is not a get to it when you have time situation. This is a do it now or lose it forever situation. Because come January 1st, any losses you didn't harvest, they're still losses. They still hurt your portfolio. But now, they're worthless losses. Losses that can't reduce your tax bill by even a single dollar. Move number 2. Maxing out your retirement contributions. I know, you've heard this advice a million times. Everyone tells you to max out your 401k. But here's what they don't emphasize. The contribution deadline for employer retirement plans is not April 15th like your IRA. It's December 31st. Once the year closes, that contribution space is gone, forever. You don't get to go back and claim it later. For 2024, the 401k contribution limit is $23,000. If you're 50 or older, you get an extra $7,500 catch-up contribution, bringing your total to $30,500. That's not some random number the IRS pulled out of thin air. That's the maximum amount of your income you can shield from taxes by putting it in a traditional 401k. Every dollar you contribute reduces your taxable income by $1. If you're in the 24% tax bracket, maxing out your 401k saves you $5,520 in federal taxes. Just like that. Not to mention state taxes on top of that. But here's the part that drives me absolutely crazy every single year. Employer match. Let's say your employer matches 50% of your contributions up to 6% of your salary. If you make $80,000 a year and you contribute 6%, that's $4,800 from you. Your employer kicks in another $2,400. That's $2,400 of free money. Literally free. You did nothing extra to earn it except contribute to your own retirement account. But if you don't hit that contribution threshold before December 31st, that match evaporates. Your employer doesn't roll it over to next year. They don't mail you a check. They just keep it. You left $2,400 on the table because you were too busy in December to update your payroll deduction. And here's the thing. Nobody talks about. You can front load your contributions. You don't have to spread them evenly across the year. If you realize in December that you're $10,000 short of maxing out, you can adjust your final paychecks to contribute more. Maybe even contribute your entire December paycheck if you have enough cash reserves to cover your expenses. The math is simple. Would you rather have that money taxed at 24% right now, or have it grow tax deferred for 30 years? Because that's the real choice. Now let's talk IRAs. Traditional and Roth IRAs have a $7,000 contribution limit for 2024 or $8,000 if you're 50 or older. Here's the good news. IRA contributions can be made up until the tax filing deadline, typically April 15th of the following year. So you have a bit more breathing room. But here's why I'm mentioning it anyway. If you're doing a Roth conversion, that's a different animal entirely. And that brings us to move number 3. Roth conversions. This is the move that separates people who understand the tax code from people who just follow it. A Roth conversion is when you take money from a traditional IRA, which is tax deferred, and convert it to a Roth IRA, which grows tax-free forever. When you do the conversion, you pay income tax on the amount you convert. And here's the critical part. That conversion must happen by December 31st. You can't do a Roth conversion for the previous year. The window closes at midnight on New Year's Eve. Now, why would you voluntarily pay taxes today on money you could keep tax deferred? Because of tax rate arbitrage. If you're having a low income year, maybe you took time off, maybe you're between jobs, maybe you retired early but aren't collecting Social Security yet, your tax rate right now might be the lowest it'll ever be. If you're in the 12% bracket now, and you know you'll be in the 22 or 24% bracket later, converting traditional IRA money to Roth while you're in that low bracket means you pay 12% now to avoid paying 24% later. You just cut your lifetime tax bill in half on that money. But here's where it gets really powerful. Roth IRAs don't have required minimum distributions. Traditional IRAs force you to start taking money out at age 73, whether you need it or not, and you pay taxes on every dollar you withdraw. Roth IRAs? Never. You can let that money grow tax-free for the rest of your life and pass it to your heirs tax-free. But only if you do the conversion while you're alive, and only if you do it before the end of the tax year. Here's the strategy almost nobody talks about. Fill up the brackets. Let's say you're single and you made $40,000 this year. The 12% tax bracket for single filers goes up to about $47,000. You have $7,000 of space left in that bracket. If you convert $7,000 from your traditional IRA to Roth, you pay 12% tax on it, about $840. That same $7,000, if you convert it 10 years from now when you're in the 22% bracket, would cost you $1,540 in taxes. You just saved $700 in future taxes by being strategic about when you pay. But you had to act before December 31st. Move number 4, charitable giving. And before you roll your eyes and think this doesn't apply to you, stay with me. Because the way most people donate to charity is leaving massive tax benefits on the table. Standard charitable giving is simple. You donate cash, you deduct the amount from your taxes. But here's the problem. With the standard deduction being $14,600 for single filers and $29,200 for married couples filing jointly, most people don't have enough itemized deductions to beat the standard deduction. Which means your charitable donations might not actually reduce your tax bill at all. They just make you feel good, which is fine, but there's a way to feel good and save on taxes. Enter bunching. Instead of donating $2,000 every year, what if you donated $10,000 every 5 years? Same total amount, same causes, but now in the year you donate, your itemized deductions might actually exceed the standard deduction. Combine that $10,000 donation with your mortgage interest, state and local taxes up to the $10,000 cap, and other deductions, and suddenly itemizing saves you real money. The other 4 years, you take the standard deduction. You've effectively converted donations that had zero tax benefit into donations that reduce your tax bill. But here's where it gets even better. Donating appreciated stock instead of cash. Let's say you bought shares of a company 5 years ago for $3,000. Today, those shares are worth $10,000. If you sell those shares and donate the cash, you owe capital gains tax on the $7,000 gain. At 20%, that's $1,400. Then you donate the remaining $8,600. Your deduction is $8,600. But if you donate the shares directly to the charity, 2 things happen. First, you avoid paying the capital gains tax entirely. That $7,000 gain is never taxed. Second, you get to deduct the full market value, $10,000, as a charitable contribution. You just turned a $7,000 gain into a $10,000 deduction without paying a single penny in capital gains tax. The charity sells the shares tax-free because they're a non-profit, and everybody wins. Except the IRS, which collected $0 from a transaction that would have generated $1,400 in taxes under the normal method. The catch? You have to donate by December 31st. Charitable contributions only count in the year they're made. You can't backdate them. And this is where people mess up every single year. They intend to donate in December, the holidays get crazy, they forget, and suddenly it's January 3rd. That $10,000 deduction they were planning on? Gone. Now it counts for next year's taxes, which they'll file in 14 months. The tax benefit is delayed by a full year, which means the time value of that tax savings is lost forever. Move number 5. Flexible spending accounts. The most frustrating deadline of them all because it's pure use it or lose it. If you have an FSA through your employer, you elected to set aside a certain amount of pre-tax dollars at the beginning of the year to pay for medical expenses. For 2024, the limit is $3,250. That money comes out of your paycheck before taxes, so if you're in the 22% tax bracket, every $3,250 you contribute saves you $715 in federal taxes, plus whatever your state tax rate is, plus Social Security and Medicare taxes. We're talking about $1,000 or more in total tax savings. But here's the brutal part. If you don't spend that money by December 31st, it disappears. Your employer keeps it. The government doesn't get it. You don't get it. It just vanishes into your employer's FSA forfeiture account. Americans forfeit billions of dollars every year in unused FSA funds. Billions, money they already earned, already set aside, and just forgot to spend. That's insane. Now, some employers offer a grace period until March 15th of the following year, or they allow you to roll over up to $640 to the next year. But not all employers do this, and even if yours does, you're still forfeiting everything above the rollover limit. If you have $2,000 left in your FSA on December 31st and your employer only allows a $640 rollover, you just lost $1,360. Real money. Your money. Here's what drives me crazy about this. There are so many ways to spend FSA money that people just don't think about. Prescription glasses, sunglasses with a prescription, contact lenses, that dental work you've been putting off, physical therapy, chiropractor visits, acupuncture. Over-the-counter medications are now FSA eligible thanks to recent rule changes. Pain relievers, cold medicine, allergy pills, all covered. First aid supplies, sunscreen. You can buy a year's supply of contact lenses in December and still have it count for this year's FSA. You can schedule medical appointments for December and pay with your FSA even if the appointment is in January as long as the charge processes before year-end. The deadline is absolute. Expenses must be incurred by December 31st unless your employer offers a grace period. And even then, you're just delaying the inevitable. If you have FSA money sitting there unspent, you need to spend it now, not next week, now, because that money has an expiration date and once it's gone forever. Now let's talk about why these deadlines exist in the first place, and why your brain is probably fighting you on taking action right now. Because this is where understanding the psychology becomes just as important as understanding the tactics. The IRS doesn't care about your schedule. The tax code doesn't take a holiday break. These deadlines exist because the government has to close the books on the tax year, and they pick December 31st as the cutoff. It's arbitrary, it's inconvenient, and it's completely non-negotiable. But here's the deeper issue. Your brain is wired to avoid urgent but uncomfortable tasks, especially during a time of year when you're already overwhelmed with holiday obligations. This is called present bias. Your brain overvalues immediate comfort and undervalues future benefits. Spending 3 hours researching and executing a tax loss harvesting strategy that will save you $800? That's future benefit. Lounging on the couch watching holiday movies? That's immediate comfort. Your brain will choose the couch every single time unless you consciously override it. And that override is hard, especially in December when you're exhausted and overstimulated and just want the year to be over. But here's what you need to understand. The cost of inaction isn't just the money you lose, it's the compounding effect of that lost money over time. That $800 in tax savings from tax loss harvesting? If you invest it and earn 7% annually, that's over $3,000 in 30 years. The $2,400 employer match you forfeited? That's over $13,000 in 30 years. We're not talking about pocket change. We're talking about real, life-changing wealth that you're leaving on the table because December feels too busy. The people who build real wealth don't have more time than you. They don't have some secret energy reserve. What they have is a different relationship with deadlines. They treat December 31st like it's tax day, because functionally, it is. It's the deadline for the majority of tax advantage moves you can make in a given year, and they plan backward from that deadline. They don't wait until December 20th to figure out if they need to harvest losses or max out their 401k. They check in November. They take action in early December. They build in buffer time because they know that holiday chaos is predictable. Here's the framework I want you to use. Treat these 5 moves like a December checklist, not a January regret list. First week of December, review your investment accounts. Look for any positions that are down for the year. Calculate the potential tax benefit of harvesting those losses. If it's meaningful, execute the trades. Don't overthink it. Don't wait for the position to recover. If you want to maintain exposure, buy something similar after the 31-day waiting period. Second week of December, review your 401k contributions year to date. Pull up your pay stubs or log into your retirement account. How much have you contributed? How much is your employer match? Are you on track to max out? If not, can you increase your contribution percentage for your final paychecks? Even if you can't max out completely, getting closer means more tax savings and more employer match captured. Third week of December, evaluate Roth conversion opportunities. What's your income for the year? Are you in a lower tax bracket than usual? Do you have space to fill up your current bracket without bumping into the next one? If yes, convert traditional IRA money to Roth. Pay the tax now at the lower rate. Your future self will thank you. Fourth week of December, finalize charitable giving. If you're going to donate, do it now. Don't wait until December 31st when charities are overwhelmed and processing might be delayed. If you're donating appreciated stock, initiate the transfer early. Brokerage transfers can take several business days. If you're bunching donations, make sure you're actually exceeding the standard deduction threshold. If not, consider pushing donations to next year when you might have other large deductible expenses. Final week of December, audit your FSA balance. Log into your FSA account, check your remaining balance. If you have money left, spend it. Schedule appointments, buy eligible supplies, stock up on prescriptions. Don't let a single dollar go to waste. This is the system. It's not complicated. It's not even that time-consuming. What it requires is the willingness to prioritize financial optimization during a season when everything else is screaming for your attention. And I get it, that's hard. But here's the thing, holiday stress is temporary. Financial regret lasts all year. Every time you file your taxes and see how much you paid, you'll remember that you could have paid less if you just acted in December. The real magic here is understanding that these 5 moves work together as a system. Tax loss harvesting reduces your capital gains, which might drop you into a lower tax bracket, which creates space for a Roth conversion. Maxing out your 401k reduces your taxable income, which might make your charitable donations more valuable because you're itemizing anyway. Using your FSA funds prevents forfeiture, which means you're getting the full value of the pre-tax benefit you elected at the beginning of the year. Everything connects. Every move amplifies the others. And that's the difference between people who keep more of their money and people who hand it over without realizing they had a choice. The choice exists. The opportunities exist. The deadline exists. What often doesn't exist is the awareness that these opportunities have an expiration date. Well, now you know. You can't unknow this, which means you have a decision to make. You can treat this like every other piece of financial advice you've heard and tell yourself you'll get to it later. You can bookmark this video and forget about it until January 3rd when it's too late. Or you can treat this like the deadline-driven, money-on-the-line situation that it actually is. Because that's what this is. Real money. Your money. Money that will either stay in your pocket or vanish based entirely on whether you act before midnight on December 31st. The IRS isn't going to remind you. Your employer isn't going to remind you. Your brokerage might send you a generic year-end planning email, but they're not going to walk you through exactly what you need to do. That responsibility is yours. And the window is closing. Not metaphorically, literally. Every day that passes between now and December 31st is one less day you have to execute these moves. So here's what you're going to do. Right now, before you watch another video or scroll to the next thing, you're going to open your calendar. You're going to block out 2 hours this week, not next week, this week. Label it Year-End Money Moves. And during those 2 hours, you're going to work through that checklist I just gave you. Review investments for tax loss harvesting. Check 401k contributions. Evaluate Roth conversion space. Finalize charitable giving. Audit FSA balance. 2 hours. That's all this takes. 2 hours to potentially save thousands of dollars. And if 2 hours feels like too much time, let me reframe that for you. If these 5 moves save you $3,000 total, which is completely realistic if you execute even 3 of them, you just earned $1,500 per hour. Show me another activity that pays $1,500 per hour. I'll wait. It doesn't exist. This is the highest value use of your time you'll have all year, and it expires in 3 weeks. Your future self is counting on you. The version of you that exists next April, filing taxes and calculating how much you owe, is depending on the decisions you make right now. That future version doesn't get a vote. They can't go back in time and fix this. Only you can, only now. Before December 31st turns these opportunities into regrets. You're no longer the person who loses money because of arbitrary deadlines. You're no longer leaving thousands on the table because December felt too busy. You're the person who treats year-end financial planning like the high-stakes deadline it actually is. You're the person who keeps their money instead of handing it over by default. That starts today. That starts with action. Your move.